Good morning, everyone, and welcome to the November meeting of the Lextran Pension Committee. My name is Fred Combs. First item on our agenda is our call to order, so I'll take roll. Mr. Dial.
Here.
Mr. Birch.
Here.
Ms. Kelly.
Here.
Ms. Falkenberry.
Here.
Mr. Watkins.
Here.
Mr. Schoninger is absent, but we do have a quorum this morning. The second item on our agenda is the approval of our minutes from our August 13th meeting. Everyone should have had those in our packet. Are there any corrections, modifications, or a motion to approve the minutes?
Make a motion to approve.
Second? Any discussion? All in favor, please say aye. Any opposed? Motion carries. All right, the next item on the agenda is the fund performance report from Mariner Wealth Advisors. So you can take it
All
away.
right, thank you. It's good to see everyone. I'm Pam, this is Eric. I think you all know us. The first couple pages in the book, if you have that in front of you, just an update on the firm. There's not a lot of new news since last time. I think you're all aware that we now do have an office in Lexington, so we are spending a lot more time here, which is super exciting as our company continues to grow. Page 3 is just a kind of snapshot of where we are in terms of locations across the country. Not that that means a lot to any of our clients, here locally, other than it is giving us more and more resources. As we do, become larger, we have more that we're doing in various areas, investments and other areas for our clients. But we are a privately held firm, and so that does allow us to do really everything that we do is built around and for our clients. So it's really a nice combination of that broad resource and access, but also this kind of close local relationship that we're able to have. So in page 4 is our team. Eric and I are here today. But then turning to your investment policy statement on page 5, we always want to just reiterate what we are, the plan that we are operating under, which is yours. So we want to make sure that we're all on the same page with the objectives. So the key elements of this are on the executive summary on page 5. Asset allocation is the driving force of what your returns will be in the pension plan. So we have what we would consider a moderate approach here, with the stocks in a range of 50 to 80%. That is what will give the portfolio the growth that it needs to have long term to be able to continue paying the benefits in perpetuity. But we want to have some degree of buffer against the volatility that can come from stocks, and so that's why we have the allocation to bonds, and so that's in a range of 20 to 50%. Everything else about your investment policy statement is to make sure that it is very well diversified, high quality, prudently managed, and some of the highlights are listed here in terms of the specific requirements. And again, this is a policy that you've had in place for many years, but we always want to remind you of what those parameters are. The full document then is on these next several pages. So is there any interest in discussion on any points or questions regarding the policy? That everyone's still feeling comfortable with this approach? Okay. So if we turn to that next section of the book, or page 17, on the PDF if anyone's on electronically, just an overview of what we've seen in the markets in general. So here we're looking at a chart that goes through the first 3 quarters. So at the end of September, we've provided the updated numbers through October on the far right, and these are just the different stock market returns that we see as we look at what has the market done in general. So they're color-coded here with that reddish color is the S&P 500. That's what we usually think of first as far as U.S. large company stocks. But also in blue is the Dow Jones Industrial Average. So you can see through the end of October, the S&P was up 21%, the Dow was up 12.5%. Continuing to see that big diversion because of what we've seen in some of those very largest companies within the S&P 500, since that's a market capitalization weighted index. It has become a little bit more skewed to just those largest companies. So we will see at times when those very largest companies are the strongest, and there could be a time when they're the weakest performers, we see the S&P skewed a little bit more because of that, just because they make up a larger larger portion of that. But it's helpful to see both of those as just a frame of reference for kind of U.S. large company stocks. The gray and the yellow are international markets, gray being the gray being the emerging, and then yellow being the developed markets. So those two together, both at about 7.3% through the end of October. And then the orange, which is lowest on the chart, but it had risen through the end of October, is the Russell 2000, and that's small companies. So that has a return of almost 10% through the end of October. The market has continued to change even more since then. We've had an election. You're probably aware we've seen continued upward movement in most stocks since then, really as the expectation has become that it's more likely that certain tax rules will remain in place longer. The lower corporate tax rate that we have in place now is now expected to still remain in place, so that's a positive from a just company profitability standpoint, which is what we're invested in when we invest in stocks. That's a big reason for what we've seen. There are additional concerns that could be out there too, and so some of the policies that have been talked about in terms of tariffs is one that can be of concern for markets down the road. Particularly as it could be, an impact on inflation. It's something that could lead to higher inflation. It's the expectation of those tariffs has already led to the dollar becoming stronger, which is great if you're out traveling in Europe and your dollar can buy more. But when you're a U.S. company exporting, a stronger dollar actually makes your profits reported in dollars look lower. If you're selling things in Europe or Japan or wherever and you translate that back into US dollars, it's actually lower. So there are a couple of different ways that those tariffs could be a negative for US companies in a couple of different ways. So just things to keep in mind. It's early to know how is all that really going to play out. But the market has already just started responding to what are the expectations for some of those factors, because the market's always looking forward to what's coming next. But as of right now, everything has been very strong. So the next page, on page 18, is a little bit more of a take on the bond market, and this is looking at interest rates for treasury bonds across maturities from 3 months out to 30 years. Just at several different points in time. So the lowest line on here back in 2020 was the lowest that rates got when we were in a very, very low rate environment. So for example, you see the 10-year treasury bond there was at a yield of only about 0.5%. So just very, very low. With the 2022 inflation and higher interest rates that came along, that led to all bond rates going higher. So you see the highest that it reached in 23, where that 10-year bond got up to about 5%. Now those have come down a little bit as we have seen the rate of inflation slowing down, so that's a good thing. And we've seen those bond rates coming down a little bit too. So that 10-year bond there at about 4.3%. From an investment standpoint, having rates at these higher levels, but not crazy high, but where they are, makes bond investments actually very attractive. So as we buy new bonds for your portfolio, we're buying individual bonds, holding them until they mature. It's as we buy new bonds that we're locking in those rates for the life of that bond. So if we buy a new 5-year, 7-year bond, we're now able to hold on to that rate for the full life of that bond. So as investors, it's a nice thing to be able to really earn what we would say is a better, more fair return out of that side of the portfolio. So that's a very good thing. So then turning to page 19 is a summary of the portfolio. So the pie chart on the left is looking at your asset allocation. We have equities at a total of 73% as of the end of October, within your range of 50 to 80. So slightly towards the upper end of that range, which has been a beneficial thing because we have seen stocks doing so well. You can see in the pie chart the different asset classes that make up that 73%. The largest of that is the large cap, so the U.S. large companies. But we do have additional diversification from mid-cap, small cap, and international, so a nice blend of those different kinds of stocks. And then that 27% is the buffer that is in the fixed income, so to provide a little more stability versus the volatility we can get in stocks. And then the performance is in the upper right-hand corner. So here looking at 4 different time periods, but for the year so far through the end of October, year to date, the total portfolio had a return of 12.8%. And then the components below that, the fixed income and the equities, 3.7 and 17.2. That's after also a very strong year in 23, as you know, 20.9%. 22 was the negative year with the higher inflation and interest rates, but we've certainly emerged fully from that. And then that longer term average 10-year return right now at about 8.2% per year, which is, I would say, above average, higher than we would want you to expect, but very much flavored by this very strong surge that we've had here recently. So that average over 10 years has been driven by the stocks, the stock return of 11.1%. Okay. And then the next page is just a bit of an accounting of the past 3 years, kind of where each year started, flows in and out, and then it shows the return in dollars, which is just kind of nice to see it in addition to percentages. So you can see, just the magnitude of both the dividends and interest are an important part of the return, but the largest portion is going to be the appreciation that you see from the stocks in the portfolio. So that market value increase or decrease is shown there as well. Okay. Any questions at a high level before we dig in on the specifics?
Excellent, thank you. So page 21 is a breakdown of the individual holdings within the active portion of your equity portfolio. And as we've gone through in the past, from left to right, we look at these names in 3 categories. The left side of your stock portfolio will be the more value-oriented and more specifically focused on dividend growth and more conservative position as reflected by beta. Beta is a statistical measure of volatility relative to any benchmark, but we're benchmarking the S&P 500. So if you look at the S&P 500 as having a benchmark beta of 1, anything less than 1 is going to have slightly less volatility or have less volatility. Anything greater than 1 is going to have greater volatility than the overall market. The center column there, the 5-year dividend growth rate, is really I would say the primary focus, because a dividend growth rate as opposed to just simply a dividend payout is a reflection of a healthy business with healthy cash flow. In that we're not only paying or rewarding our owners for being shareholders, but we're able to consistently grow that number. And so to see growth ranges primarily in the double digits of growing dividend payouts is the sign of a healthy and stable business. So a company like Procter & Gamble, for example, which has been doing it for years and is considered an aristocrat because they grow their dividend every single year for decades now, is the sign of a healthy economy or a healthy company. The center group is the cyclical growers, and the easiest way to think of the cyclical growers are those companies that are positioned to benefit and perform well in the current economic environment. So if we look at central themes right now, financials are doing well as interest rates readjust, and so you see some exposure there in names like Goldman Sachs. But you also have seen a long-term trend really since post-COVID of whether you call it friendshoring or reshoring or nearshoring, but manufacturing coming back towards the U.S. as we grab tighter control of our supply chains. One of the names, some names pop out that you recognize, but I like to find some of the other stories in here. And WillScot Mobile, if you're ever on a construction site and you see the temporary outbuildings, or if you think of school, if you went to school like I did and you had the school wasn't big enough and they needed to put the outbuildings, that's what WillScot does. And so with all of the construction and everything that is burgeoning in the U.S., somebody has to supply those temporary office facilities, and that's what WillScot does. And so they are well positioned. They may not be the forefront name that you might think of in terms of those construction operations, but those are the companies that are the follow-on that have very healthy and growing businesses. We reflect the cyclical growers in a higher earnings per share growth and but a more, I would say, moderate to growing price to earnings ratio, and so you see a higher level there. And then the names on the right are kind of the superstars of the market, recently. Those are going to be your higher growers. That's where most of your Mag 7 is going to live. That is where the attention of the market has been in the higher growth names. So again, you see a lot of names that you'll recognize there. That's where NVIDIA lives and Meta lives. Facebook and Tesla certainly is in there. But if you scroll down to Synopsys, for all the chips that are made, somebody actually has to test those. Synopsys tests the circuitry on the chips before they go out. So again, there's businesses along the chain beyond just the big flagship names that we're all heard of, that are just tremendous businesses that are growing. So again, in this higher growth, you do see the higher earnings per share growth, and you'll also see a little richer price to earnings ratio because the market is rewarding the faster growth. Your top 10 within your portfolio breaks out on page 22, and I do want to highlight just kind of the top names, not for highlighting the companies, but highlighting their weights, because, and we'll talk about this when we get to the sectors as well, but it is important to note that we are providing diversification. So even though you see names that you recognize that will also be top names within the index, recognize that NVIDIA at 6.71% of your portfolio is 6.77% of the S&P 500. Apple at just under 5 is 7% of the S&P 500. So while these are healthy weight names within your portfolio, they are actually underweight and not directly related to what the overall market, the S&P 500 is weighted at. That follows on to page 23 with the individual, the sector allocation as well. And you do see a little bit of divergence here, but largely this is within ranges of the overall market. So where technology is an enormous weight, when you look at it on paper, it is actually underweight the overall market because the technology weighting in the S&P is 33%. The consumer cyclical is really your only thing that is, I would say, overweight. Consumer cyclical houses Amazon, houses Tesla, so some names that might find their way in there. That's slightly overweight. Everything else is within 1 or 2% of the overall S&P. So there's not big bets or being made within the sectors. We're simply looking for the best company opportunity, which is a reminder that because this is an actively managed portfolio, you see that chart of stocks and there's more weight on the right side than the left side. That's where the market has been rewarding. When that ultimately reverses and more attention is being paid to the value and stability group, then you'll see more names over there because we are actively managing the portfolio to maximize your risk-adjusted returns. Page 24 is the equity position of your passive holdings. And this is something that we have believed, and I believe in strongly, that it's the argument between active and passive is not a productive one. That active complements passive. They trade off times when they can outperform, and so we want to have both, and your portfolio certainly does. And so within the passive group or of index trackers, you have the growth index and the value index for large caps. This is also where we get our mid cap and small cap exposure with IWM, and is also where we get our international exposure with the EFI index, which is the Europe, Asia, and Far East index. So the combination of active and passive gives us a nice balance of getting index representation as well as active management to, again, provide the risk-adjusted returns that the plan needs. On page 25 is the bond breakdown. And the only thing that I would emphasize here is that we are taking advantage of the interest rate environment that is being provided to us. There has been more opportunity to collect outsized returns on the short end of the curve, meaning the near years, the 1 year, 2 year, 3 year, up to 5 years than it has necessarily been on the long end. One of the benefits that we'll see is that as interest rates reduce, as they have been on the short end, the value, the statement value at least reflected on your bond positions there will increase and will go up. Now, we buy individual bonds, not bond funds. So ultimately, we're holding the bonds to maturity, and the rates themselves are what's locked in. So having the rates at those shorter maturities locked in and paying a higher level is something that the plan will continue to enjoy. Any questions on the plan specific holdings before I move on to more of the macro environment? So on page 27 is a long-term track of real GDP for the economy, or how the U.S. gross domestic product has been growing since 2000. And what continues to amaze me and what stands out to me is that the blue dotted line is the long-term trend line, and regardless of what happens in the short term, we continue to snap right back to that long-term trend line. And so you see, for example, in 08, financial crisis. You see in 2021, you see the effects of COVID, and you see spikes down, but ultimately a resilient economy comes right back to its long-term trend line. The reasons are detailed on the right, and there's one in particular that was brought to my attention by our chief economist that I really appreciated the talk, but we'll focus on the blue category. One of the reasons why our economy keeps growing is because consumption drives the U.S. economy. We're really good at consumption in this country, and so whatever happens, we're very resilient because we just like to keep consuming. So that is nearly or over 2/3 of the overall economy, and that continues to push. The second category, though, is interesting and something I hadn't thought of previously, that at nearly 18% or 17% of the economy is driven by government spending. I'll always ask, show of hands who thinks government spending is going down anytime soon. That continues to grow at pace. And that, while it has its negative consequences that we've talked about numerous times and will continue to be talked about, and are real, one of the benefits of that is that it does provide a smoothing effect on the economy. That when we hit turbulent times, that you still have a government spending mechanism that is providing fuel into the overall economy. While it can create a lower ceiling, it can also create a higher floor, and will tend to smooth out economic cycles. Which is why we have not seen the type of massive spikes and prolonged spikes that we saw, for example, in the Great Depression. There is a reason for that. It's not just coincidental. So, but we are on the long-term trend of economic growth. Inflation concerns are subsiding slowly, but they are subsiding, and subsiding enough where the Federal Reserve has felt comfortable to reduce interest rates again. And a couple of the things that I would point out, that not only are the overall rates subsiding, but there are actually sectors of the economy that are in a deflationary cycle. Energy is actually in a deflationary cycle where prices are going down, not just growing less slowly or more slowly. core goods, so the stuff that you have to buy, is actually in a price reduction mode at this point. That's very good news across the board. The areas that continue to be pervasive, and we'll see where they come out. Auto insurance, we've covered in here before, and everybody is well aware of in this room, continues to be a thorny issue within the inflationary cycle. Eat at home, don't eat out, and you'll save yourself a lot of money. That's one area, and then shelter. And shelter is such a tricky thing. We're not actually sure that this is an accurate number. Nobody's sure it's really an accurate number. It may actually be lower than this. The methodology for calculating that is, we'll just say, problematic and challenging, no matter who's doing it. A lot of what drives inflation is labor market pressures, and we have seen those post-COVID come down to the point now where the unemployment rate has dipped dramatically to 4.1 from its 14, nearly 15% peak, and wage growth it continues to grow, although wage growth as a inflationary pressure has subsided as well, and so that is playing into the overall economic picture. And then on page 30, as I mentioned, the Federal Reserve again has decided to lower rates again by another quarter point. Now what's interesting here, and I was going back and comparing some of our older charts, if you see the green line on the right, that's market expectations. And if, like me, you save these, and when you're having trouble sleeping, you back and review, you'll notice that tail didn't exist previously. Previously, the market expectations were roughly in line with what the Fed was saying, and that rates would be coming down at a steeper pace. Well, the market now believes, due to our current growth structure, that we may not see the slope or the dramatic decrease in rates that was once believed, that may moderate, and we may be in a slightly higher rate environment for a little bit longer than had been previously anticipated. So we'll see how that plays out, but I did find it interesting that tail showed up where it hadn't been before. And then finally, this last page, when we're evaluating positions, we look at fundamentals, and we validate that with or check individual company valuations, where their prices are and the like, and then we certify those basically with technical indicators, and this is what our chart here reflects. Without going through these line by line, what you'll see is our view and our expectations are neutral to positive all the way across the board. The only thing that has a slight negative tilt to it is sentiment. Now, most people, when I say sentiment, it's your feels, right? Sentiment's actually a technical definition, and without getting into how it's calculated, it really says when everybody who wants to be invested is invested, that might suggest a market top. Might suggest that things are a little too frothy when you're buying NFTs and just have silly money to spend. That might suggest we've exhausted. What this is telling us is that we're not necessarily there, but we can possibly see it from here. So that's just one of the factors that we take into account when we're looking at how we're allocating money. And I can't close without our favorite slide of all time. A reminder that the market declines and they're normal. The average decline in a calendar year, in any given calendar year, even years when you have a positive year, is 14.2%. We tried to have one a couple of times. We got as low as 8%, but I would remind you the year's not over yet, and those declines are from existing peaks, and we've had quite a run-up. So it would not surprise me and surprise us if we did have some type of, again, normal correction, and if it happened, it would be a normal correction. The way I can illustrate this is October. October's never had a year where we've made it through the entire month without having at least a 1% decline. You know when we had a 1% decline this year? On October 31st. That's when we had a 1.5% decline in the S&P. So the year's not out yet, so we could still have that decline. But again, just a reminder that that's normal, and we're investors, not traders. And with that, I'm happy to answer any questions that anybody has.
No questions? Thank you both. We appreciate it. All right, so the next item on our business is old business. You ready?
I am, sir.
All right, take it away.
It was stated in the last meeting by the actuary, Mr. Osborne, that a $2.40 contribution would sustain a $60, an increase of $10 from $50 to $60, a contribution of $2.40, considering the surplus of near 40%. He said $2.40 would sustain a $60 multiple benefit if the surplus was to be reduced to zero. It has been negotiated that an additional 17 cents will be added to the contribution, bringing the contribution to $2.44, which is 4 cents more than the recommended rate of $2.40 by Mr. Osborne at the last meeting. So we are going to make the motion to raise the benefit to $60.
Okay. So the motion needs to be to direct me to take it to the board for a $60.
Right.
A $10 increase.
Yes.
Okay. We have with us Mr. Jody Carrero, who is Steve Osborne's partner. So I just wanted to welcome you and let everybody know that you're here with us in place of Steve.
Yes, thank you. Good morning, everyone. Yeah, I'm here and ready to, I've paid attention to your plan and have reviewed it for Steve for several years, so happy to answer any questions or clarify anything as needed.
Okay. So let's get clarity on the motion. The motion is to increase the benefit from $50 to $60.
Correct.
Okay. And what would happen from here, should this committee pass that resolution, is I would take that to the next board meeting for approval by the board. Should the board approve, then, Jody, do we need to specify a date when this would go into effect, or can we say this goes into effect upon board approval?
When we do, I guess when you do the amendment, we'll have to put a date on it, so.
Okay.
It would probably be good to put a date in the motion
All
while
right.
you're at it.
Would we want to give some time to do processes, paperwork, or can we say the day of the board meeting? Like, would you need, and maybe, Nikki, that's for you, the day of the board meeting? So the next board meeting is November the 20th? Is that right?
Yes.
Okay. Jody, would that be good for you on your side to say November the 20th? Should that pass the board of directors?
Yes,
That good
yeah,
with you?
that'd be fine.
Absolutely.
All right, so let me see if I can phrase this correctly. The motion on the floor is to direct me to take a resolution to the board of directors to amend the benefit from $50 to $60 effective on November the 20th, 2024. The only other item I want to bring up is in the event we don't have quorum. And I think in that case, we would bring it up at our next board meeting in December. That's the only procedural issue I see with this. So is it okay if we say if it doesn't go into effect in November due to quorum issues, we'd bring it back in December? Is that a fair statement, Jody?
Yes, absolutely.
Okay. Okay. So I'm happy with that, if you guys are happy with that.
And this is for future retirees,
For
not
future retirees, yes.
Yes.
Yeah, that's important to say,
Okay.
Yeah.
whether you're doing anything for the retirees or just for future, everyone that retires after that point. Yeah.
Thank you for adding that, Bill. I forgot that.
Yes, yes. So, then the motion on the floor is to direct me to bring a resolution to the Board of Directors to increase the benefit from $50 to $60 for all future retirees, beginning on November the 20th, 2024. Does that sound good to everybody?
Absolutely.
Good? Nikki, good?
Yes.
Jason, good?
Good.
Okay. Do I hear a motion to approve?
Make a motion to approve.
Do I hear a second?
Second.
All in favor, please say aye.
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 Anyone opposed? All right, motion passes. Congratulations.
Fantastic.
So I will get to work on that resolution, and we will get it in front of the board in November. Very good.
Thank you, Mr. Combs.
Mhm. Do I have any other old business? Does anyone have any new business?
It's not new business, but the next meeting is February 11th at 10 a.m.
Thank you, Nikki. Anything else for the good of the group? I believe we stand adjourned. Thank you all.
Thank you.